Good evening, everybody. Happy Sunday. It's April the 3rd, and this is your latest episode of Sunday Market Preview for the week. So I'm your wealth guy. Let's get started. Let's talk money. Let's talk Sunday Market Preview. But today we're going to talk about a little bit more. But before we jump to next week, you know how it is. Let's take a look back and let's talk about what we learned and what we saw last week. So first things first, there was some good news out there. The employment numbers had actually come down. As you may or may not know, the Fed likes to take a look at 4% employment as full employment, and it was actually lower. It's about 3.6, if I'm not mistaken, maybe 3.8, but I believe it's 3.6. Either way, here's the bad news. We saw non-farm payrolls actually drop. And that to me is a big indicator of a major problem. So yes, maybe less people being unemployed, but are they employed well enough? Or are they under? So that's the first thing. Maybe the second. The third thing I want to take a look at here is the yield curve, because especially on Friday, we saw that the yield curve had actually inverted, meaning short-term bonds are actually higher than long-term bonds. Now, this creates an interesting scenario because whenever we see an inversion, it's typically a good predictor of a potential recession. Now, that doesn't mean we're going to enter it next quarter or even next half year. It could very well be next year. And again, although it's a fantastic predictor, nothing's ever written in stone, especially with the crazy markets that we have now. But it really creates an interesting position for the Fed. And here's why. We have inflation that's currently running out of control, and the Fed's desire supposedly is to increase rates and cut back on the balance sheet in order to reduce inflation. Now, that we already know isn't really going to happen, even if they increase rates. I don't care if they even raise it another 0.5%. The truth of the matter is it's really not going to do anything. We've talked about that enough. But that really puts us in an interesting scenario. We have two unique positions. How do we curb inflation? Well, there's two ways. Number one, we raise interest rates as they're currently trying to do, but way past the level of inflation. So let's assume inflation is currently at 7%. You have to at least exceed it. So 8%, 9% interest rates. Now, that will essentially cripple our economy, both in the US and here in Canada. So even though we focus a lot on the US, it also really applies here in Canada. However, our inflation rate, I believe, is about 5 and change. But the other option is to essentially create a recession where people can no longer afford to purchase things, and therefore the demand decreases, and therefore inflation starts to come down. Now, you can look at it as these are two of the same, because if inflation continues to go higher and interest rates go up, by the time we balance it and bring inflation down, people won't be able to afford simple things, even things like their mortgages anymore. Let's face it, everybody's houses or incomes are tied into their mortgage, as well as other debts. I mean, we also saw an increase in the amount of personal spending in the US, and that's being celebrated as a positive sign. But the truth of the matter is, this is not from disposable incomes. After all, we saw non-farm payrolls come down. So that means that there's an increasing amount of debt being put on by the average person, which has helped boosting that confidence and that spending spree. Now, another factor in there is we're not spending necessarily on items of luxury or things that we would like to own, but rather just the increase of inflation and the increase in cost is causing that number to go up. So is it necessarily a positive? Are we really celebrating something good here? Just some food for thought. Now, the economy is not strong, whether or not we want to think it is, whether or not CNBC or whatever television network is telling us. The economy is not strong. The economy is in free fall, both in the US and especially here in Canada. So it's just food for thought. But let's have a look at other news, because last week we've seen crude continue to fall. And even though long-term I'm still quite bullish on crude, we did see it pull back quite significantly, dipping below $100, which is a big deal considering we were up at 125 not that long ago. Now, part of the reason is U.S. reserves being pulled. I believe it's at 100 million barrels. Maybe at 1 million barrels. Sorry, not 100 million, 1 million barrels. Now, increase. Now, that is a very, very far cry from the actual shortfall, but it does ease the prices quite a bit. But the other thing is we have OPEC Plus, which has refused to make any move, even though they increased the output very slightly, I believe a few 10,000 barrels per day, nothing significant in order to help curb this shortfall from Russian fuel, or Russian oil, I should say. So is there still that potential for that bullish market trend upwards for crude? Absolutely there is. Even with the US pumping additional oil from the reserves, it's only a matter of time before oil starts to move upwards. Again, it's the lifeblood of the military-industrial complex, and contrary to what anybody wants to tell us, it is a critical and crucial part of infrastructure, and as well as manufacturing, as well as technology, as well as every sector we'd like to look at. The other area we saw pull back quite significantly is actually gold and precious metals in general. Now, gold right now is currently sitting at about 19 and a quarter. Now, there is that potential for gold to pull back a little bit further, as we saw it dip below 1900 on Friday. Now, I believe Thursday. But now, gold does have that potential to move lower, as I mentioned, and I'm setting a target in the low 1800s, potentially around 1830, potentially dipping even lower. Now, I don't see it going back to its previous low in the 1600s or below 1700. However, I am looking at 1900 to be a point of entry for myself, and if it continues to dip lower, I will continue to buy on the low. Now, overall, I am still very bullish on gold. And part of what's keeping gold propped up was a lot of news externally. So we did see that potentially the ruble is going to be pegged to the yellow metal, although confirmation of that is still a little bit up in the air, and there's a little bit of back and forth between a number of different sources as to whether or not that's actually true. Either way, we saw an increase in Russian purchases of gold, not necessarily at the level of the government, but I'm talking about the individuals, because Russia decided to remove the tax on gold, which allowed people to purchase and essentially preserve their wealth as the ruble saw a major correction. Let's have a look at next week. So crude will continue to have this potential volatility as the US Reserve will start to pump out, I believe, next week. If we take a look at additional risks, gold should be able to hold steady here in the 1900s. However, we could see that potential dip below. At this point, economically, unless there's a major shakeup, I don't anticipate gold really dipping too far into the high 1800s. But for now, we'll just say that it's going to trade within its comfortable trend, sitting between 1900 and 1950. Overall, the market, I think this week will probably have a little bit of an upwards continued momentum. There isn't a lot of news out there really pushing it down so far. We will continue to see that move to all-time highs as we continue to approach that number. Believe it or not, it's really not that far away. Conversely, at the same time, if we do see some negative pressure here, I think it would be absolutely fantastic. I've been talking about a major pullback for quite some time, at least as far as it's a positive for the market. Anytime you have an upwards trend, you'd like to see a pullback, and that's even what we've seen with gold recently, as well as crude, as we saw a 13% pullback here. Now, ideally, I'd like to see, as I mentioned, the markets continue to pull up. If we don't get that, pull back. If we don't get that, you can expect additional volatility as we increase higher and higher. I think this week will be fairly quiet as the economic calendar isn't too busy, but we do have the Fed minutes coming up this week, and we will be hearing from more than one Fed representative. So keep that in mind, as we're going to hear a little bit about monetary policy this week, and that has the potential to shake up the market. If we see the US dollar react positively, you can expect gold to continue to pull back a little bit further. But that's it, everybody. It's going to be a fairly quiet one. Expect continued volatility, but I think overall we're probably going to have a positive week. I will see you tomorrow morning at the opening bell.